Hi, and welcome to another edition of the NAIC Insight Series. I'm your host, Bob Greene, and I am delighted to be joined today by Andrew Junkin, the Chief Investment Officer for the Virginia Retirement System. Welcome, Andrew.
Thank you.
It is awesome to have you here. I have been looking forward to this conversation. And tell us a bit about your role as CIO of the Virginia Retirement System and a little bit about the plan itself.
So the Virginia Retirement System is the 14th largest public pension plan in the United States. We're about $105 billion, broadly diversified across all the asset classes you would expect. We provide benefits to 800,000 members at this point, which is something that we spend a lot of time talking about internally. I mean, we have great jobs in the investment business that are intellectually interesting, but we keep trying to tie it back to, we're here to serve the people that serve the state of Virginia.
That's outstanding. One of the things that I am familiar with about the Virginia Retirement System is you have a fairly large investment team. Talk to us about how your team is comprised and what areas they focus on.
So we have about 80 people on the investment team, making investment decisions all the way through mid and back office. Our portfolio is public equity, private equity, fixed income, private credit, real assets, and then we've got some what we call multi-asset class solutions, which are generally designed to help mitigate some of the drawdown risk that's present in the public equity strategies. We're about 85% funded. We're a little bit cash flow negative every year in the fact that benefit payments exceed contributions by 2.5% or so. So we have to be very careful about liquidity. And performance has been great. I've been the CIO for all of 10 months, so I can't really actually for 6 months. I've been on the job for 10 months. So I can't take credit for much of the returns, but I don't think I've messed up anything at this point. I'm not sure they're actually letting me around any of the real significant decisions yet.
Well, I'm sure you will eventually get there. And I say that in jest as you did, knowing that that is a job like an airline pilot that from the moment you sit in the seat, you have the controls in your hand. So the neat part is that VRS is an extraordinarily well-respected organization nationally, and kudos and congratulations to you on joining such a fabulous team. Andrew, you came into the job as a CIO. This was not a promotion. While VRS has more assets, you were the CIO for the state of Rhode Island. Talk to us a little bit about that role and just from a personal standpoint, what you had to go through to get your mind around making a change from Rhode Island to Virginia.
Yeah. So by the time I came to Virginia, I had been in Rhode Island for a couple of years. Prior to that, I was on the consulting side of the business, and we can delve back into that part of my history. But that was the big switch, was from consulting to the CIO role at Rhode Island. It also happened to be right at the beginning of COVID. It was June of 2020. So I had to move across the country in the middle of the pandemic, or at the beginning of the pandemic, and moving east of the Mississippi for the first time in my life. Had a very good team there. Portfolio was really in good shape. In many cases, you might say I joined at an ideal time, because the initial panic over COVID had kind of come and gone by the time that I came on board, and the markets were settling down. The portfolio was in good shape. It was a much smaller team there. There were really kind of 5 of us that were making investment decisions. Coming as I did with consulting in my background, in the structure where we had 3 different consultants was kind of immediately familiar to me, and I didn't feel sort of out of sorts. I felt like I kind of fit in and could rely on the team and then the outside experts. And I felt like I knew how to get the most out of the consultants that were there. And they were all really great resources for me and for the rest of the team.
So, Andrew, as you know, I work very closely with investment managers, mostly in the alternative asset class space. And despite their view on the world, you do not spend every minute of the day thinking about how to make allocations to investment managers. Why don't you give us a typical day, if there is such a thing as a typical day? But what's a day in the life of a big plan, $100+ billion? What's a day in the life of a large plan CIO like?
Yeah, I think you're right. So manager sourcing is not really my remit at this point. I do make lots of connections between managers that do approach me and then the right teams in our organization, because I don't want people to feel like they're sort of screaming into the void. The sort of day in the life is a little hard for me to answer because for the last 6 months we've been focused on our every 3-year asset liability process, which has really been a big project and it's taken a lot of time. We are not making significant changes to the portfolio, kind of bar one, which is we're adding a little bit of leverage, 3% of leverage to the total portfolio, which is not a big step, but it is opening that door. And I think that the next time we do the ALM process, we'll know much better whether or not that's something that we want to continue. It obviously would have made a lot of sense when rates were at zero, but they are where they are. We're actually using it to increase our ability to further diversify the portfolio. We're not looking to drive returns with it. So I talked about our multi-asset class portfolio, and we're sort of increasing that as a way to increase the sort of risk offset for public equity. We're increasing fixed income a little bit. We're increasing private credit just a little bit. And then a few kind of tweaks here and there. So that's taken up a lot of my time, but really it's kind of meeting with each of the asset class teams or the programs kind of on a weekly basis or a monthly basis, what things are happening, what sort of long-term strategic projects do we need to be focused on. So now that we've got the ability to add leverage to the portfolio, we need to build out that framework. We need to build out the infrastructure. We know we have the talent to do it. We have implemented strategies that use some of the tools that we will use. We've just never used them in a levered sense. Mm-hmm. But as I mentioned earlier, we're cash flow negative. We're less than 100% funded. We cannot make a mistake when it comes to the liquidity surrounding leverage. Right. So we're going to have to be very, very good at that. And that's something where I would say we're spending a lot of time sort of identifying how we can source leverage, and just kind of like the rest of the portfolio, we want to be as diversified as we can in the different sources so that one doesn't potentially collapse on us and force us into selling assets to pay down leverage. That's kind of the point with a lot of what we did in the ALM strategy was avoid being a forced seller, right? You never get a good deal if you're a forced seller. You never get to sell at an economic value. So I think a lot of what we have done and continue to do is really kind of risk focused, and how do we not make mistakes? And then each of the asset classes, each of the programs, they're in the markets, daily, looking for ways to keep portfolios going, to make new relationships, and make money.
So, Andrew, as I recall, VRS has a very effective governance structure, and I say that because the plan has done well. The plan has had a lot of stability. I've observed it go from 60%, 65% funded into the 70s. And now, you've cited a mid 80s number, super impressive. Talk to me about how governance works at VRS, and as CIO, how does that impact you and what you can do, and frankly, how your team operates?
So governance here is something that we're very, very pleased with. We're in some ways very protective of, because we do think it's a competitive advantage of ours. So the board makes the asset allocation decision, and then we implement it. And so the board is not involved in manager selection. We report back, obviously, on how things are going in a number of different ways, not just performance, but ultimately the implementation of the portfolio is up to us. And I would say that's, back to your prior question, that's where I do spend kind of the day in the life kind of times is working through, hey, are we going to do this particular co-investment? Are we going to re-up with this manager? Are we going to make this allocation to a new manager? Are we going to rebalance across strategies? Are there any opportunities that we want to be sort of thoughtful about? I hesitate to use the word tactical, but even just in the timing of rebalancing, you can be, I think, thoughtful about what does that look like. When rates 2 weeks ago, the 10-year was above 4%, we were talking about moving money from cash to fixed income at those levels. But the governance is really, it does enable us to just focus on investments and how to maximize our risk-adjusted returns. And so, like I said, we're very protective of that structure. It's we actually have the prudent person rule written into the Virginia Code that sort of enacts the Virginia retirement system. So it would be a challenge to make big changes, but we don't want to give anybody reason to think about making those big changes.
For sure, for sure. So you've got gubernatorially appointed directors. You have trustees. You've got legislatively appointed trustees, and the board spends its time on a number of things, but specifically around dealing with the issues of the asset allocation. And in my dated research, you had a big bucket for public equities, and then you had, 10 to 15% in a variety of different alternatives. No need to even be too specific here, but that does give you a lot of latitude, you and your team. And again, you've got dedicated professionals, don't use a lot of consultants, use some advisors, but talk about what I know managers are curious about. Talk about how the decisions get made. Let us into the investment committee a little bit in terms of that dynamic of the idea versus the diligence versus actually committing to a manager.
So I'm going to start using a bunch of different committee names just because that's how we refer to things. So the two, I would say, key committees here are the management committee and the executive committee. So the management committee is made up of about a dozen people that all have portfolio management or strategy responsibilities, and across all of the different programs. We meet every other week to talk about where are markets right now. Are you seeing anything in your particular markets that look like opportunities or weaknesses? And kind of what's coming down the pike. Take private equity, for example. If there's a manager that we're going to be making a commitment to, whether it's new or a re-up, the recommendation actually will go to the management committee. The management committee then has a week to ask questions back to the private equity team about, have you thought about this? What do fees look like? Why was their loss ratio in Fund 3 higher than it has been in other things. So there's a little bit of trying to poke holes in it, to not to try to sink things, but to really make sure that it's kind of up to our standards, and that all of the right kind of due diligence has been done. Then we will have a presentation from the manager, more questions, and then ultimately the decision goes to the executive committee, which is me, the head of private assets, which is the head of private equity, the head of real assets, the head of credit, reports up to that person, the head of public assets, and then the head of portfolio strategy. So the four of us ultimately have the ability to say yes, no, or let's rethink the size maybe. And in fact, we've actually pushed some things up, we've pushed some things down. I would say it's not a rubber stamp, but if you've made it through the entire research and due diligence process for your particular portfolio, you've made it through the entire recommendation and management committee process, by the time it gets to the executive committee, we have a pretty good idea that this is going to be a high quality opportunity that we're probably going to be interested in.
So let me go more specific than my experience and expertise would allow, but for the sake of the interview, try and get into it. So the global pandemic dramatically changed how we think about the work environment, particularly the office environment. And I recall that VRS had a fair amount of exposure to commercial real estate. How do you guys think about, without being too specific, how do you think about the impacts of the changing workforce with the need for people to have office space? And how will that, how's your portfolio exposed, and how do you protect it?
So we do have about 14% in real assets, which includes things other than real estate. Real estate is about 9 or 10% of the total. So it kind of dominates the real asset portfolio. We were underweight office going into COVID, so that has helped relative performance. But it has been a challenge. I think we've spent a lot of time debating, are there going to be opportunities in office? And if so, what are those going to look like? I don't think we have any confidence that we have a good answer to that. I think there are going to be some distressed sales. I think once debt on the office space starts to hit maturities, there are going to be some places that are handing over keys to lenders. I'm actually in the office today. We're hybrid in the office 2 days a week, mandatory Tuesdays and Wednesdays, and then work remote the rest of the week. But because we're not hoteling, we can't really downsize or anything like that. So we're due to renew our lease, and we just kind of did some back of the envelope math on this particular building, this office building. It's not a VRS building, we're a tenant, and the debt is in a CMBS, so there's some data out there, and we think the value of the building's maybe down 60%.
Wow. And you're in downtown state capital, right?
Downtown state capital. I would argue that Richmond is secondary or maybe tertiary. It's not, you're definitely not going to build an office portfolio just based on cities like Richmond, as much as we enjoy being here. We have been focused on, I would say, logistics and kind of last mile investments in the real estate portfolio, and I think those have done pretty well. And anybody who looks at my Amazon account will understand that I'm sort of feeding that machine myself a bit.
Absolutely. I'm doing that a bit with you as well. Again, 85 people on the investment team, roughly. And it's a not so well-kept or desired secret to know that VRS has some sophisticated capabilities on your team. You have the ability to construct and operate portfolios in-house at a fraction of the cost. And I know that there's been a lot written about that, and you guys have had great success with that. Give the audience a sense of what that really means. Like, you're running a hedge fund in-house, you're running a long only team, global macro. What is it you do, and how are you able to do this with roughly state employees?
Yeah. So I would say the two big internal slices are investment grade fixed income, which we run essentially 100% in-house. And then public equity globally. And I would say of our total public equity portfolio, we run about half of it internally. 100% of our public equity portfolio is active. And so there's varying degrees of active risk in it. And the internal strategies tend to be somewhat lower risk, but they're not index strategies at all. So we've made over the years significant commitments to resources in terms of systems, in terms of people. We are, I think, not the people that work here are aware of our relationship to the state. We're not on the state pay scale, which is different than the way it was in Rhode Island. We were on the state pay scale there, and that was kind of a competitive disadvantage because we were, an hour from Boston and 3 hours from New York, and there were people on that team that were super talented, and I was worried that someone was going to show up and write them a check for 3x what they were making, and they'd be out the door. And quite frankly, if somebody got a 3x offer, I would have shown them the door and said, yeah, you need to go. So public equity and public fixed income are kind of the two big things. We do have sort of research projects where we're looking at other things that we might be able to do. Can we run internally a global macro strategy, for example, a multi-asset class approach to that? I would say that's really kind of in the exploratory stage at this point. But something that, if we could convince ourselves that we could run that effectively, that we would stand it up and we would do it. We have not really done any sort of significant kind of long short strategies anywhere. It's mainly long only. I think with the introduction of leverage, that will change how we implement certain things. We're likely to get much of that 3% leverage through the derivatives market. So we may end up synthetically implementing part of our public equity, for example, or part of our fixed income strategies, and then be able to actually redeploy the cash instead of fully collateralizing it, which is kind of what we currently do. We take that cash and deploy it other places.
So moving to the topic of leveraging diversity as a strategy. 5 years ago, the NAIC recognized the Virginia retirement system for its efforts around diversity, and it had significantly increased its allocation to diverse managers. However, no one would argue that VRS is doing anything overly progressive, right? There's no carve outs, there's no set asides, there's no quotas, none of that stuff. It's all market and opportunity based. From my standpoint as an outsider, I think the plan has done extremely well in growing its assets with diverse managers. But as a new CIO who has some experience in the space, give me your sense of where VRS is around being inclusive in investing with a broad array of talented managers.
Yeah, I think that that we are very intentional about that, and that obviously predates me. And so, full credit to the team here and the prior CIO, and in particular a prior chair who might have pushed a bit there. I think his name was Bob Greene. But I think that everyone here fully understands that this is a talent identification issue for us. And at $105 billion, we're big, but we're not Norway. We're not CalPERS. And we always need to be looking for kind of the next wave of talent, wherever that is. And we have kind of built into, I think, our processes some inclusivity. And I think with me joining the team and given my background and some of the work that I've done other places, I think there's an ongoing effort to continue all of that, and to be in the market and to make sure that we're making connections and that we're understanding what's going on. At $105 billion, are we going to be seeding fund ones? Probably not. No. But we need to be, we need to recognize that there really is no private equity firm or private credit or public equity firm that is going to last forever. Right. Changes happen. So for us, this is about making sure we have the widest aperture we can into what talent looks like in our industry, but also, I think, importantly, seeking it out, not just waiting for it to come to us. We have to be very proactive about it. And that also is true for our own staff. So we've made one hire since I've been here, so I can't really quote stats for my tenure, but in Ron's tenure, the prior CIO, the stats are really impressive. And the percentage of hires that were diverse was something like 60% over his 11 years here.
Yeah, and that's at a period of time when the plan gained share and gained funded status. So again, as I alluded to, kudos to the team and to the leadership. Andrew, let me take you back, because when I first met you, you were an investment consultant at one of the largest and most widely known firms, Wilshire. Not always a firm that people thought of as a beacon of diversity, but you actually became someone that became quite known and recognized for being thoughtful around the topic. I don't want to limit your conversation around working in the consulting world with Wilshire, but I do want to ask you a specific question, and we're going to talk some more about it.
Okay.
Why does the consulting world get such a bad rap around diversity? And maybe that's a leading question from an advocate, and I apologize for that. But let me rephrase it for you. I believe that consultants have taken a lot of the force and the blows around diversity and investing with women and all sorts of things have come more slowly as a result of that world. Is there something inherent about the consulting model, or is it a timing issue? What are your thoughts on the role that consultants have played in change, whether it's to resist or to promote it?
Yeah, I think there's a couple of things. So one, outside of a handful of clients and probably a growing number of clients, there hasn't been much pressure on the client side that would kind of force consultants to take a more holistic approach to this, as we ended up doing at Wilshire, and other places have too. I mean, I talk about Wilshire. I have lots of friends there. I left on great terms. I think it's a great organization. But there are other consultants that are doing some really amazing things as well, and they deserve credit too. I think the other issue is a business model issue. In the traditional consulting world, where it's a flat fee to work with a client, you're looking for, and certainly when I was running the Wilshire Consulting business unit, you're trying to find ways to be more efficient and build scale into a business model that does not lend itself very well to scale. I think that there's a certain amount of inertia that sort of goes along with, hey, we've got 100 or 125 or 300 or whatever clients, and we've got to have kind of managers across the entire investment spectrum that we've researched. And it's hard to, and I think all consulting firms are trying to do that with as few manager research people as possible. And, they're stretched. And so I think, for me, when I went from being a consultant to the head of the consulting business, who happened to continue to consult, and was able to kind of take a step back and have some conversations with people like you, with people like Robert Rabin, other people in the industry that really were, I think, leaders in advocating for diversity in our business. I thought, well, listen, I'm not going to wait for the clients to ask. I'm going to sort of put it to them in a way where they have to opt out, and I don't think anyone will opt out. And so we implemented the Rooney Rule. We changed the way that we sort of presented managers. Now this was kind of public market only managers, because private equity and other private capital strategies were kind of not necessarily in my remit at the time. And I think that's a business structure issue for that version of Wilshire. I don't know what the current version of Wilshire is like. But I basically turned it on its head in as much as I could and said, look, diversity is important. It is a talent acquisition issue. The Knight Foundation studies have clearly called that out, that whatever the number is, 3% of institutional capital is managed by diverse-owned firms. That's silly. That's ridiculous. That is a talent identification problem. And in taking it back to the clients, I said, you are going to see diverse-owned firms in every search, and we're going to call out things like diverse ownership, which I'm not sure I got precisely right, because I think there are better, more nuanced measures of diversity, but I needed something sort of quick. And I said, unless you tell us you don't want that. And nobody went, hey, I only want to see white guys managing my money. So to the credit of the clients.
So now I'm going to give you an opportunity on this platform to help managers better understand their clients. What is it, if you could put your finger on one or even two, it's up to you, things that managers seem to never really understand or to constantly get wrong about working with public pension plans or big institutions, identify what that would be, and how should they think about their approach or their support or their engagement differently?
Well, I think the first thing that probably comes to mind is that there's not always going to be a home for every single great product or firm in an institutional portfolio. It may not fit the strategy of that particular investor. It may not fit just in the sense of timing, particularly now as lots of people are over allocated to private equity because of the denominator effect. But wanting to sort of maintain existing relationships with high conviction managers, it's maybe even harder to open some of the doors and the lines of communication. So I would say a no doesn't mean we're invalidating your strategy, or it doesn't mean we're invalidating, your approach, your firm, anything like that. It just may not be the right fit at the right time. So I think that a lot of it is, and my LinkedIn inbox may explode after this, but I think a lot of it is kind of being persistent and taking a broad approach to sort of building your own business. I've experienced where managers get really focused on one particular investor, either as a consultant or as the CIO, and we've tried to make it apparent that it's not a good fit, and they sort of continue to press, and ultimately we just have to say, listen, no, it's not going to work right now. And those are always tough conversations. But I think that, you know, there's no secret, I don't think, to building a business. It's marketing, making connections, building your network, using your network to get into places, to make introductions, and to build long-lasting relationships. I would say at VRS in particular, the phrases that I've heard here that other people have used is we date for a long time, but once we make an investment with a manager, you know, we're going to be in the next several funds. Mm-hmm. It just takes a while to kind of get us to the table.
Yeah, no, I've observed that about VRS, and frankly think that is a hallmark of working with an institution that is so thoughtful about who it invests with. Andrew, crystal ball. This may have been easier if it weren't for, you know, the sort of tumultuous markets of the last 6 months. But where do you see the industry going? And when I say the industry, I mean the asset management industry, right? You know, some of the concepts of passive versus active management, you know, the dwindling of the long only books, the maybe the pullback of private equity, and, you know, repositioning into private credit. What are the levers that you think are going to get pulled over the next several years, and what's the impact of those?
Well, I think private credit is definitely one, and you know, VRS has had what we call credit strategies. It hasn't always been sort of pure private credit. It has evolved into essentially pure private credit at this point, and it's, you know, the target allocation there is 15%, which I think puts us probably near the top of the heap in terms of an allocation to that. The opportunities that we're seeing, the uncertainty about the economy, the uncertainty about the markets, the pricing in particular in U.S. public equities, you know, I think the expected return for U.S. public equities, using most of the same kind of models that we would have used at Wilshire or that other consultants would use, would be kind of sub 6%. And when you can make, you know, 5+ on investment grade fixed income, or 10 to 12 in private credit, you know, it's an opportunity that you can't not pay attention to. I worry about private equity. To be fair, I've worried about this for probably 10 years, that it's become so institutionally accepted that some of the very high returns that we've grown accustomed to are maybe being arbitraged away by the amount of capital, the pace at which it has to be deployed. You know, managers want to deploy all of the capital that gets committed. And that makes me question, well, is this really a good deal for whatever fund it may be, or is it because you need to start the fundraising cycle for the next fund, right? Managers are in the business to make investments, but they're also in the business to make money, and there's nothing wrong with that. I think, you know, I was recently at a conference and just had a sidebar conversation about AI, and I hate to even bring it up. And, you know, we're trying to get our arms around it here. And this particular conversation made me think nobody's running fast enough to get ahead of AI. Right. And you know, the recommendation I got was find something on YouTube that's weekly update on AI capabilities, or something that sort of looks reputable, and, you know, you can watch it in 10 minutes a week. But the pace of change there, and it, you know, it's shocking. I don't think that's going to put institutional investors out of business, but I think, you know, it's making me rethink how public markets probably get implemented. we had the quant meltdown of whatever that was, 2006, 2007. And a lot of it was because quants were all kind of leaning on the same factors. Well, does that happen with AI, except it's exacerbated, or does AI prevent that from happening? I don't know. I think if everybody just plugs in to ChatGPT, give me an optimal equity portfolio, everybody's going to get the same answer, right? Yep. So there are going to be people that are really good at this, and there are going to be people that are really bad at it. So I think just adding AI to your marketing page is probably not quite the answer. I think, better understanding of it than I have is probably required.
No, I hear you. And I appreciate you bringing it up, because it frankly is an ominous topic, right? Because the more you allow your mind to think about what AI is and what it could impact and what downstream changes belie it, the more you can sort of get lost around this sort of journey. I can only compare it to the journey towards e-commerce. I was a management consultant when e-commerce first came out, and we were reading books and pamphlets on it, and then we were 2 weeks ahead of a client in terms of wanting to do a strategy around it, right? Mm-hmm. And 20 years later, Amazon boxes show up at my house every single day, and Amazon further innovates and says, well, you can now have it in 3 hours if you want it, right? So right. I don't know that I would believe anyone who said they were an AI expert right now in terms of what it's really going to mean to everything. But I do, it resonates with me what you're saying, which is the degree to which the business environment, the technology world, and the policy world come together. Mm-hmm. And I think that, I'll throw the question to you. How do you as a CIO manage the timing around those things, right? Because, you don't want to be too soon, you don't want to be too late, but you have to be thinking about it. How do you as a leader and as a CIO think about the timing of how quickly we need to move towards it?
Yeah, I think that's the project that we've started to undertake, and I've asked 2 questions. How does this affect us as an investor, and then how does it affect managers and partners that we may want to do business with? So, what sort of things can we do internally? And again, I go back to our internal public equity mandates. We have biases that I think everybody would probably suspect we have. We have a value bias. We have a small cap bias. It's not a big one. We have a little bit of low vol in the portfolio. These are things that have persisted over a very long period of time. And like everybody else, we're getting killed by the same 10 stocks that keep going to the moon. But do those factors that sort of have historically had a lot of persistence, does AI take advantage of that? Does it take advantage of it in a different way? And we've done some work on large language models internally. We've got a team of 2 that are sort of building those out. And I'm thinking, well, that's great, but there's probably teams of 50 at some of these managers. And even if we can tease something out of it, what are the odds that we tease something out that nobody else has gotten? Yeah. I think the odds of that are pretty low. So does it make sense for us to be building AI models? I kind of have a hunch no. I think that's a race that we can't win. I'm not even sure we can stay competitive in it. So then that means we've got to figure out, A, what's the scope of the impact, and then B, who do we partner with?
So I want to shift gears a little bit. It goes without saying that you are a leader, and your job requires every ounce of leadership that you can bring to it. Talk to me about your preparation. In particular, what are the key experiences over the course of your career that prepared you for this role?
Looking back, I still have a bit of imposter syndrome. Like, how did I end up here? And I think that those sort of critical moments, you never recognize, or I never recognize sort of at the moment, hey, this is kind of a big thing. Mm-hmm. in particular for VRS, this was, a well-planned transition where Ron announced, gosh, more than a year before he left that he was planning on retiring. It enabled the board to engage in a thoughtful search process. It enabled me to overlap with him for 4 months. But one of the things that I really focused on here, and I would say in some prior jobs too, was culture, right? And I think that that is very easy to mess up a good culture, and it's very hard to fix. And a good culture takes a long time to sort of evolve. So because this transition went as it did, I was able to kind of come in and kind of do more listening than having to take over during a time of sort of rapid transition where I've had to do that before, and I've had to make decisions. Hang on just a sec. My screensaver just came on and I had a moment of panic. Where business strategies needed to change rapidly.
Yep.
And that is, I think, that requires a different kind of leadership, right? I think you have to really explain that vision and get people to buy into it very quickly and move quickly. And I think I had some success and some failure at that. And I think the transition here, where the culture was good, the performance was good, in fiscal 21, like many other investors, we had our highest return year on record. Mm-hmm. In fiscal 22, and this is a source of much complaining about from me, the total fund outperformed the benchmark by 600 basis points.
Right.
$100 billion. I was like, I have to follow that up. This is not, I've got to reset expectations here. But, when I came in the first all-staff meeting, I was focused on the 800,000 beneficiaries that we have. I was focused on, our mission is to support them, to help them have safe and secure retirements, with dignity after serving the state of Virginia. And I was happy to see that people had already bought into that. Right. And so I was kind of aligned there. I think one thing in particular that I remember reading and discussing with colleagues, this has been before probably I was in a leadership position, but it is something that certainly influenced me, was the culture of the organization is set by the worst behavior that a leader tolerates. Mm-hmm. And that has stuck with me, right? The people that have bought in, the people that are sort of the standard bearers, they're going to be that way. They're going to lead by example. The people that sit back and question decisions or strategy or, cause cultural problems, either they need to be rehabbed or removed and quickly. Otherwise, they begin to really drag down the high performers that have embraced the culture, right? And if that's when those people start to question, well, why are you putting up with that? Mm-hmm. And I'm on the same pay plan that behavior is on. That's when I think you start to lose the game.
So in that spirit, let me let's play a quick game called More of, Less of, right? Mm-hmm. Give me a couple of things that under your leadership we're going to see more of at VRS, and a couple of things, anything that we're going to see less of. And I know I will fully acknowledge to the audience that we did not prepare this, so I'm putting you on the spot. So if you want to punt this question, you can, but let's play more of, less of.
Yeah, I'll try. I'm going to say more of a focus on process, Um, I, and that's not to say that VRS was without processes. It certainly was. I think that I'm driven by processes. How does this compare to other things that we've done? Are we being consistent from one situation to another? I was preparing for a different panel, and one of the questions on the list was, what makes a good investor? And I thought, and I think it's the ability to stick with a process, sort of regardless of the outcomes, but with a little bit of flexibility to sort of recognize that not every situation is the same. And so when I started here, I actually bought, I think, 50 copies, one pretty much for everybody that was in the investment process, of Thinking in Bets, which is a book by Annie Duke, and she's a former poker player. And basically the takeaway is you can make good decisions and have bad outcomes. And if you judge your decision-making process based on the outcomes, particularly in a business like ours, where you can make all of the right decisions, but something happens in the market that no one could have foreseen, that looks like a bad outcome. But if the process was good, you shouldn't abandon that process. So I think more process, more thinking about things in process, less of, I don't know. I'll have to punt on that one.
All right. Well, as a native Richmonder, I will bet you that as we enter into August, you want less humidity.
I would take less humidity. I would take it already.
See, there we go.
My office in particular is cold in the winter and hot in the summer. It's not well insulated, I guess.
So let me take the remaining time and we'll have some fun. What's it like living in Richmond?
It's been good. So I did not know I was looking for a job, and so I bought a house in Rhode Island in December of 21, and then I took this job in May of 22. Don't recommend 6-month hold periods for anybody in the residential real estate area. The hardest part of moving down here was giving up my 15-year 2 1/8 mortgage.
Yeah.
The other thing that was really challenging, interestingly enough, was there was just no housing inventory. It took me months to find a house. And I ended up in a new neighborhood, like a brand new neighborhood. I was the first occupied house on my street. I can stand on my back porch right now and see, 15 houses that are in various states of being built, and every single one of them is already sold, and all of the vacant lots are already sold. So Richmond itself has been, to me, it's a very livable city. I don't think I was cut out to be a New Englander. I enjoyed Rhode Island, particularly in the summer, not so much in the winter. I now have, maybe a little less love for the heat and humidity, but the winter's going to be great.
Now, the fall and the winter will be great. Summer is rough in Richmond, lots of humidity, but the thing I'm most optimistic of about the town is just it's become a foodie destination spot, right?
Yes.
So you're down in downtown Richmond, and it's just a great lifestyle. So, Andrew, you have been an awesome guest today. Really appreciate your insights, as the series suggests. Also appreciate your thoughtfulness. I watched you from afar work through your views on a number of different things around diversity and around the investment consulting industry, but moreover, I've watched you be consistent and to be an advocate, and appreciate that. So look forward to continued success for you and the Virginia retirement system, and thank you so much for your time today.
Well, thanks for having me on. It was great.
Awesome. Take care. Have a good summer.
All right. Thank you. Bye.
Bye.